please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, you'll have to say that it's been a fairly decent start for the bulls at a time when the backdrop was a little somber from Asia, with US yields touching 3%, the 10-year. The flat start and the maintaining of the flat trend is certainly a positive. Midcaps are actually up about 0.2%. Advanced declines are still only marginally in favor of the declines, 1.3 in the red for 1 in the green. But it's only the banking space which is a spot of bother, especially public sector banks. And my sense is that the auditor's note to both Reliance Reliance Naval and Infra is something that's set a lot of the banks a little worried. Now you will have to recognize this in some form, in the form of higher provisioning. Yeah. And who knows, there will be other companies. It's just that the auditor community looks like has gotten worried about getting pulled up for divergences, and so they are being ultra careful in the way they qualify accounts. So this could be a problem for the entire corporate lending side of the banking space.
Oh, absolutely. And you know, Gati, by the way, second day running is seeing a double-digit move right now. So it's at the high point. Nimesh was telling us yesterday that there will be a board meeting on the 26th, which is tomorrow, to find some new strategic partners in the business. So I think someone's betting big on that ahead of that board meeting.
Yeah, I think the big bets really are in IT. And as we discussed, of course, midcap IT, NIT Tech is the leader over there. But look at a stock like Tata Elxsi now. That stock is also making highs of the morning. So all the big players which had corrected over the last 2 or 3 days are now beginning to make a bit of a comeback. So spoke about NIT Tech in the morning. Now Tata Elxsi is the one which is making a big move right now.
Okay, since we're talking about that, let's get a management of one such company on board. Zensar Technologies Q4 was a mixed bag as the margins declined, but the other income supported the profit. The board has also approved a stock split in the ratio of 10:5. Sandeep Kishore, the MD and CEO of Zensar Technologies, joins us now to talk about that. Sandeep, thanks for being with us on CNBC TV18. The worry that the street has is the fact that your constant currency growth has slowed down quite a bit. If you look at the last 4 quarters, this quarter has just come in at 1.1% versus, 3 to 3.5% that you have done in the past few quarters. Is this a trend that we can expect in the next few quarters as well?
I think, we are executing quite well. On the US dollar term, this is our 4th consecutive quarters of 3+%. 1.1% on constant currency that you're seeing is largely on account of US, which grew about 1.5% on constant currency. And given that US is about 70% of our market, it does kind of weigh itself in. We are executing well to the digital strategy. Digital actually now in last quarter grew almost 8+% sequentially and 35+% year-on-year basis. So the plan that we have for being in the digital space, actually we are quite pleased with the performance that we are delivering. Our PAT also, as you called out, grew by almost 7% on year-on-year basis and 23+% on a sequential basis.
Okay. Well, morning, Sandeep. Can you give us some idea of what the outlook is? Do you see more orders coming in, considering that the US is in seriously proven growth phase, and therefore can we expect an improvement in margins as well? Are billings improving?
So, we've actually announced 2 of the large deals in the last 12 months, which are north of $50 million plus TCV deals. And that will start to play itself in as we go into fiscal 19 for us. And when you drive scale, we do believe it will have its play into the margin as well, because you have better levers of efficiency to impact. The second, obviously, interesting input is the automation. As you start to add more and more work, which is delivered from offshore, you have a propensity to do more through automation. So we feel pretty good that you will see an uptick into the margin as well.
Okay, would you quantify it? Because this time the EBITDA margins fell a bit, that's why I'm asking.
Yeah, we don't give forward guidance, but the reason EBITDA margin actually fell down is because we had to take a provision for one very specific customer in the US retail sector. But on an operating basis, if you take that one-time extraordinary out, I think the EBITDA margin actually is pretty good.
Okay, I just want to come back to the digital strategy because, you know, that's the new buzzword in the IT space. You spoke about an 8% growth this quarter. What do you see as a sustainable trend? And more importantly, as a part of your overall business, currently it's 40%. How much do you think it could grow to?
So digital is the main pivot for our growth. I mean, if you take a look at over the last 2 years at Zensar, what we have been driving, we've almost doubled our digital business. So we are now running, you know, at about $50+ million on a quarter for digital business. And I do feel based on the pipeline that we have and all the platform that we have developed in Zensar, that you should see a, you know, momentum of 8+% sequentially on the digital business.
Okay. Just a final word, therefore, what kind of growth can you talk about? Is there any guidance you can give in terms of either constant currency or dollar revenue growth?
No, we don't give forward guidance, you know, but if you've seen the trending in fiscal 17, year on year, we actually grew by about 1.5%, fiscal 18 by about 5.8%. So we are pretty confident that you will see a higher growth than what we have delivered last year into fiscal 19.
So NASSCOM's guidance for the full year of FY19 is about 7 to 9 odd %. You think you could fit into that bracket?
We'll certainly try and beat that.
Oh, okay. All right. That's a pleasure. Sandeep Kishore, thank you very much for joining us with the fine print of Zensar's performance. That's the word coming in from Zensar. Pretty confident, 1% higher on the stock.
Actually, the stock has moved up now after the management's confident outlook came in. Of course, the numbers were far from impressive, but the fact that they could even do better than NASSCOM's guidance, I think is...
And also, I think the margin is a one-off. I guess the markets would have taken some heart from that.
I just keep an eye on the rupee as well. Now, 66, 65 almost, you know, there on that one. And, you know, that, of course, is a bit of a tailwind for the IT sector. And that has been the 66 now is what we have on dollar rupee. So Nifty is outperforming the bank Nifty, which was the call in the morning as well, because it's got more components which are doing well for it compared to the bank Nifty, and the Midcap index also up a bit. Ultratech Cement, of course, will be declaring numbers. And that will be on our radar as well. Numbers come out later today. Nigel, what are we expecting?
Well, Anuj, we'll look out for the numbers at around 2 to around 2:30 p.m. Today. In terms of the numbers, top line, big growth we're going to see there. Close to around 29% in terms of a top line growth. Majority of that top line growth is only because of sales volumes. So the sales volumes numbers that we're working with is around 17.5 million tons. Now, how do we see such a big jump up in terms of sales volumes? Well, that's because the acquired JP Cement's assets, that's going to be consolidated in the books. So that's what gives a big rise to the top line. In terms of realizations, well, that'll be as flat as can be. Maybe 1% higher or 1% lower. But bulk of the top line comes in only because of sales volumes. For the acquired JP Cement's assets, we're looking at capacity utilization levels of around 60%. Remember, in the first quarter of this fiscal, it was only around 15%. So good top line growth, but in terms of operating profit, that'll come up by only around 14 to around 15%, telling you that when you have a top line growth of 28% and you have only 15% in terms of an operating profit growth, margins should get compressed by around 200 basis points. Why is that? Realizations are flattish. JP Cements, yes, that'll help the top line, but in terms of profitability or EBITDA per ton, that's lower than what Ultratech Cement normally gets. And when you have flat realizations and your input cost goes up, like petcoke as well as diesel, that's what compresses margins. Profit number, that'll degrow by close to around 20%. That's because, in fact, the acquired JP Cement's assets will lead to higher interest costs as well as higher depreciation costs. 2:30 p.m., we should get it today. Back to you all.
Okay, thank you very much for that, Nigel. Well, let's get back to earnings. Remember, Persistent Systems had guided that there will be a fall in their IP earnings. The kind of weak numbers that they reported was expected. Dollar revenue declined by 4.6%. Profit slipped over 19%. But both these numbers were actually better than what the street expected. So that's why today you're seeing an uptick actually in the Persistent stock itself. I think it's up about 2% when I last checked. To give us more color, yeah, there it is, 2.4% higher. To give us more color, Anand Deshpande, founder, managing director and CEO of Persistent Systems, joins us now. Thank you very much, Mr. Deshpande. Well, first up, you know, Q4 was weak on expected lines because of that IP portfolio decline. If you could tell us if this is a one-quarter impact, and also, can you recover some of this lost revenue pretty quickly?
Yes. So clearly, you know, this was a quarter-on-quarter dip of about 4.6%, and we ended the quarter at $116.95 million. Most of it was because of an IP event that essentially what happens is that we are working with partners who have a calendar year for their calendar year. And when we look at the numbers for Q4 as compared to Q3, those numbers are significantly lower, which is what the dip was. When we look at the calendar 19 for our partners, the numbers still look quite good for them. And we expect that some of the dip that they had in the Q1 of their first quarter of calendar should be able to recover as we look at the rest of the year.
So what about IP revenues in calendar year 19? Will it be better than this year?
Yes, that is correct.
Okay, so that's good to know. IP revenues will be better. You're guiding for FY19 to be better than FY18. Would that be on revenues and margins? And would you like to call out any number at all?
I don't want to really call out a specific number at this time. It's still very early in the year, and we are just closing on a negative quarter-on-quarter number. So I don't want to call out a specific number. But see, there are a few things that I would like to point out. One is that if you look at the mix of business that we are in at the moment as compared to our previous year, we are on a better situation as compared to the previous year. Our interactions with customers, the quality of business, the kinds of work we are doing with several of our customers, specifically in healthcare and financial services, are all looking very good. So we do expect that, as we look at the next quarters and the subsequent quarters, we should be able to get a better number and growth rates than we had this year.
Mr. Deshpande, good morning. Your company is already operating at peak utilization rates. So going forward, what could be the margin levels from here on?
No, so I think the improvement in margins is not going to be because of utilization improvement. It is going to be because of improvement in what we are able to charge our customers. And for that, I think there are two reasons why I think there is better opportunity to charge. One is the kind of mix that we have now as compared to last year has improved quite a bit, and that allows us to charge a little better. And as you would notice, the market climates in the US and everywhere else are such that there are no immediate rate pressure on the business. So we think we can increase a little bit on the rates as well. So the combination of revenue growth, higher utilization, which we will maintain, and the fact that we can charge better will give us better margins overall. But see, it's like this right now. This year, I really need to focus on growth and sales. So we are going to invest this year on additional sales capacity, which we think will help us improve the overall growth rates as well.
Got that. Okay, it's an interesting point as well. What has been the extent of the rate increase so far?
So over the year, I think about 3 to 4% increments in rates have happened across the board. But again, they are not all like-to-like comparison because the mix of business has been changing as you go along. And the newer digital business that we have comes in at a better rate structure than the previous old business that we have.
So the company has been very active on the acquisition front in the recent past. Anything that we can expect this year?
There are nothing in the current portfolio, but during the year, I'm sure we will do them. We are suddenly looking at several different areas, specifically around growing our business in European geography, and also looking at technology-related areas, and specifically in healthcare and financial services as well. So we will do some acquisitions during the year, but it is sort of hard to predict exactly how those will look at this time.
Oh, yes, point taken. But thank you very much, Mr. Deshpande, for joining us with all those details. So persistent weak earnings was entirely on expected lines. In fact, it was not as weak as perhaps the street was prepared for. And the stock actually still in the green after that, after those numbers. But there's another important angle which should be important for the stock markets as well, and that's the Mumbai development plan. Mumbai-based real estate companies should be in focus because the Maharashtra government has approved Mumbai's development plan, and an official announcement is expected later today. Sonal is here to just give us the key features of this development plan.
Well, that's right, Lata. When reports are suggesting that the government of Maharashtra has approved Mumbai's development plan and this announcement is set to follow on today. Now, what this plan really proposes is it'll unlock 3,700 hectares of land which is owned by private and public sector companies. These lands are currently tagged as no development zone. So basically, you cannot develop any sort of buildings, residential or commercial on these lands. And this is the largest addition to cities' developable land in last few years. And the area to be added to the city's development land bank accounts over 8% of the total developable land in Mumbai, and that is a huge chunk. And going forward, I expect that the Mumbai real estate players will be in focus. Remember, last month as well, the government of Mumbai had actually increased the FSI for all these buildings, and all this will lead to more focus on real estate in Mumbai.
Oh yes, thanks a lot for that, Sonal. Of course, this calls for higher FSI in the island city as well, creating malls. So not just real estate, but allied players like Century Textiles, Bombay Dyeing. DB Realty, of course, is the cleanest Mumbai real estate player for now, 6% higher. Perhaps not as much HDIL because that's mired in so many controversies. So, but a lot of stocks doing well. But what's doing well is Midcap IT, and in fact, the entire IT pack. That's trying to sort of combat the weakness in the Bank Nifty, which is down about 125 points. Ashwini Gujral, Mitesh Thakkar back with us, Sandeep Bagle also joining us. Ashwini, your thoughts on first hour of trade? As we were discussing, it was about IT. But from here on, how would you approach rest of the day and your stock calls?
See, the Bank Nifty is now beginning to show follow-through. So we've just taken short positions on Bank Nifty. IT is doing well, but it's the only sector which is up. So my sense is that the others which are suffering because of a weakening rupee, they should move on the downside. But really, the big trend only starts once we start breaking 10,550. But all through the day, I think buying should be visible on mid-cap IT particularly. So that way, the calls right now are, long IT, short bank. So NIT Tech is a buy with a stop of 1,020, target of 1,065. Tata Elxsi is a buy with a stop of 1,200, target of 1,265. And Mindtree is a buy with a stop of 1,000, target of 1,045.
And no deal on the indices?
On the Bank Nifty, you can get short now.
Okay, yeah, it is about IT. Ashwin has given 3 IT stocks. Hexaware also making a bit of a move now. 2% higher is what we have on that. Mitesh, your trades?
Yeah, so I have one buy and one sell. Grasim, I think, is breaking down on the hourly chart, so that's a sell. Keep a stop at about 1,087 and look for targets of around 1,044. While Bajaj Finserv, and this is one stock which has kind of managed to do well despite the fact that the entire sector is kind of facing some negative news flow. That's a buy with a stop at 5360 and look for targets close to about 5600.
Okay, by the way, the future group stocks are also starting to move with quite a bit of gusto this morning. So Future Consumers is now up almost about 4% and it has been a pretty stable stock. This month it's put on about 15% weight. But let's get Sandeep Bagle also on board. Sandeep, hi, good morning. What are you looking to buy or sell now?
Good morning, Sonia. I would go with a buy in a Muthoot Finance, stop loss of 445, target of 467, and a buy in a Mindtree, stop loss 1017, target 1071.
Okay. Some savage profit taking in Yes Bank. It had a very good run, and the weakness in the Nifty Bank is being used to take some profit off Yes Bank, at least by tactical traders. Ashwini, is there a call on Yes Bank?
All the banks are at best choppy, so it's very clear that where the money is moving. So possibly, today banks are seeing profit booking and that money is moving towards IT. Yes Bank at best range bound, it goes up 4% one day, gives back the next day. So no great trend. Maybe you can say it's range bound between 295 to about 330.
Okay. There are big moves in ICICI Pru once again today. In fact, CLSA has a target price of 560 on that stock. Let's actually get Abhishek to tell us more about what brokerages are saying. Abhishek, over to you.
Well, Sonia, the brokerages are making a huge positive out of the VNB margin, that is value of new business margin, which actually measures the profitability of new business flowing into the company. So that value of new business margin came in at 16.5, which compares to 13.7% 10% on a sequential basis and about 10.1 on a YOY basis. Even if you remove the one-off tax assumption, which they had a benefit, the value of new business margin would have been at 15.2, and that's a jump of over 500 basis points on a YOY basis. So positive turn in the annualized premium equivalent growth, the rise in protection mix in the overall APE portfolio, and the steadiness in persistency ratio actually provides further leverage for margin expansion for ICICI Pru. So brokerages have turned positive. Entire list that I have over here are bullish on the stock, and target price ranges from 550 to 570 rupees per share. Back to you.
Yes, I can see that. CLSA, Nomura, Credit Suisse, Morgan Stanley and Prabhudas Lilladher, all of them having targets between 520 and 570 on the stock. Today up 5.6% after a monster 10% rally yesterday. So I think you must hear it from the man himself. Our colleague Yash Jain caught up with Sandeep Batra, Executive Director, ICICI Prudential Life Insurance, yesterday, just after the results. Let's listen into a bit of that chat. Yash began by asking him about the financial performance for the fourth quarter.
During the year, I think we have delivered a robust all-round performance. Our total APE grew about 17%. Within that, the protection APE grew by about 70-odd%. The highlight of the year has been our value of new business grew to by 93%, and if I see a 3-year CAGR number, it is about 68%. Now, you have to see in the context of what we have done for our consumers. If you see our persistency numbers, it is closer to 87%, and the way we calculate persistency, we have not put single premium in its base, neither have we got group in its base. So we believe it's clearly one of the best in class and is a very strong indicator of the quality of the business that we have written. Similarly, our cost to TWRP on the savings side, where we measure efficiencies, has reduced from about 13.3% to 11.8%.
Your gross premium has grown by about 15%, which is essentially lower than the industry growth, just marginally lower than the industry growth. Your new business premium has declined by about 4% year on year for the fourth quarter. What are the key reasons for that slightly sluggish performance as far as the premium growth is concerned?
I think you have to split it into two parts. I think one, we had a very strong quarter last year. Secondly, I think as we have been progressing, there has been a little bit of a leveling of sales which happen quarter on quarter. Most importantly, I think it's important, as I said in the beginning, look at our annual numbers. We have grown 17% as APE, and within that, the protection business has grown at about 71%. Now, if I see the protection CAGR over a 3-year period, that itself is about 80%.
What is the range that you've decided as far as your growth is concerned on the premium front, as well as to what improvement do you see as far as your value of new business margin is concerned in FY19? Is there any sort of ballpark figure that you're looking to grow, targeting?
No, we believe on a long-term basis, India offers great opportunity on the savings side as well as protection. Savings largely on the back of financialization of savings, and protection because of under-penetration. We do believe that the savings business over a longer term will grow ahead of the nominal GDP, and we will grow marginally ahead of that. And that's the view we have been saying consistently, and we maintain with that. We are as excited about this business today as we were a couple of years back. From a shareholder perspective, we are focused on increasing the value of new business. As I mentioned, we had increased it significantly during the course of the year, and this will be a function of product mix and growth.
What kind of focus are you planning to put as far as increasing the sale of term products is concerned? And with that, if that push really materializes, how do you see the value of new business margin shaping up in FY19? Because that is one space which gives you the best amount of margins.
Protection this year was about 4.46 billion compared to about 2.6 billion in FY17. So it has grown by about 70-odd%. So I think the focus will remain on protection. Focus will also remain on savings. The opportunities are different. We are equally committed to the savings business as well as the protection business. So as you did point out, protection has a little more higher margin than the savings business. If protection grows at a faster rate than savings, obviously the margin will improve.
Okay, look at the performance. I mean, after you heard Sandeep Batra in full and Abhishek's elucidation of the price targets, the stock has actually got more wings, now up 7.4%. So this is actually a near 20% gain over the past 2 days in ICICI Pru. But of course, good numbers. Well, from one good number to one difficult number, Tejas Network has slipped in early trade after the company posted a weak quarter. They are, of course, guided for lower, but it seems to be even lower than what the guidance was given. Sanjay Naik, Managing Director and CEO of Tejas Networks, joins us on the phone line. Sanjay, good morning. Thanks much for joining. It's a 62% drop quarter on quarter. I mean, if you looked at a quarter versus the year-ago quarter and full FY18 versus FY17, it's a fall of 18% in terms of revenues. You all had guided for a 5% lower growth. This is really seriously lower. What went wrong?
Yeah, so first of all, let me tell you a little bit that we are not really a quarter-on-quarter business. And if you see from an analyzed...
year-on-year. I'm comparing you year-on-year, you're fallen. Yeah, sorry.
Yeah, I was just coming to that only. So if you take that year-on-year fall is around 9.6%, if you take the change in the supply chain model that we had, which is from a job work basis to turnkey basis. So the actual on a net of component sales and all the other stuff is around 9.6% year-on-year decline. In terms of where we are, and I think in March we had spoken and given the guidance that the numbers will actually be lower than last year. And that's really because a few of our large orders have slipped down. If we actually see, we are starting the year with the highest ever backlog in the company of around 579 crores. That kind of gives you a sense that the business is very sound and healthy. And across quarters, of course, things can go in a certain way. Second thing which has happened is the fact that our international business is going through a little bit of a transition. A significant part of our international revenues came from supplying to OEM customers in North America. And we have started to build our own direct sales force in North America as well as in other emerging markets. So the international business is what declined a little bit this year, which we expect should pick up this in the current fiscal because of the number of deals and the amount of opportunities that we're looking at. So overall, I would say that yes, we did have a slip, which is kind of in line with what we had anticipated earlier in March. But the outlook still looks pretty solid.
So when you say outlook is solid, what are you expecting for the full year of FY19? Because FY18, as we said, your revenues were down almost 18%. And you did talk about the transition that you're seeing in the international business. What would be a reasonable estimate for FY19?
So year-on-year or guidance is a little bit tricky to give. But what I had indicated earlier, we have said that a 20% CAGR on a medium-term basis, which is a 3-year basis, is what we had seen happening for us. And we believe that we will continue to do that. So we did have a shortfall in last year. The current financial year, we should be able to make up for the shortfall of last year, plus be able to grow as per our medium-term outlook. So I would say this year should be a very strong growth year for us, which again indicates in the form of the backlog that we have. And in addition to the backlog, I must mention that there are a lot of orders which we are either L1 or where we are very close to bagging from the customer, which should all come back and add to the growth momentum that we are seeing.
So, all right. Sanjay, it was a pleasure speaking with you. Thank you very much for joining us. So expectation is fortunes will turn now in the next, in FY18.